Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up on your financial knowledge and sharpen your investing skills. I'm your host, Nugwa Haruna. If there's one asset class that Canadians are intimately familiar, it's real estate. Roughly two-thirds of Canadian households own their own home as of 2021, according to Statistics Canada. Meanwhile, those that don't are eager to in the future. Three-quarters of respondents told an Ipsos survey they believe owning a home is the best investment a person can make. And real estate remains a hot commodity among investors. They purchased nearly 20% of homes in Canada between 2014 and 2021, according to research by the Bank of Canada. Of course, it may not be easy for some Canadians to afford an investment property. The average price of a home in Canada was $716,000 as of April 2023, according to the Canadian Real Estate Association. That said, there are ways to gain exposure to the real estate market without a massive down payment. In fact, getting started in real estate can potentially cost just a few dollars. That's thanks to real estate investment trusts, or REITs for short. They're publicly traded securities that allow investors to purchase a stake in rental properties, just like shares in a company. We're going to hear all about this asset class from an investor who owns REITs as a complement to her multiple rental properties across Canada. Joining us is Tracy Ma, founder of Financial Nirvana Mama. Tracy, thanks so much for being here with us and welcome back to the program.
Well, thank you. Thank you so much for having me here.
It's always a pleasure chatting with you. As I mentioned, you're a real estate investor with multiple rental properties in Canada. So, how did you get your start?
Well, picture this moving from a city where every dollar seems to vanish before you even hold it to a place where it's so much affordable, where the same dollar could actually be put to work. That was my reality when I swapped a high price city for Ottawa, where property costs were so much lower, but rents were actually holding steady, pretty comparable. It's like discovering like a store filled with candy that's on sale, your favorite candy. So that's how I felt. So growing up, I was very, very fortunate where my family spoke about real estate investing. Although my family didn't have a lot of money, they never invested in real estate, but they knew of friends who were, from humble beginnings, immigrants who had pretty like not a lot of money, like working minimum wage jobs, but with frugalness and hard work, they were able to build their wealth over time. And so I was just looking at it, like reflecting on all those stories my family told me. It was so achievable, so aspiring that when I graduated from school and moved into Ottawa, I was like, I can do this. So I tried it out with my first condo. I bought it. It was a diamond in the rough condo. It was under market rent, under market value when I bought it. And I strategically purchased it knowing that I was going to convert it as a rental because I knew what the market rent could be for a condo in that location. So the numbers just worked out really well. And after that first experience, I decided to rinse and repeat it. So that meant I moved out of the condo and converted it as a rental. And then rinse and repeat that several times. So I moved a lot and also just started buying more and more rental properties.
All right. You also invest in REITs, even though, as you mentioned, you own different rental properties. So, how do they figure into your portfolio?
I'm like the game of Monopoly. Everyone's played Monopoly, where you exchange your houses for hotels. Now, that's the usually the traditional real estate investor would follow that path. If they're really into buying a lot of rental properties over time, they'll move up and level up. For me, I'm not that type of person where I want to acquire big apartment buildings because I just think of it as my lifestyle design. Like, how would I have more time for my family and my friends and all the things I want to do? So I thought investing in REITs is a great way to complement my real estate portfolio, having commercial properties, and rather than having myself to manage a big business, I would just leave it to a REIT to manage that business, collect the rents. And it involves a ton of capital too. So that was a big thing for me to have exposure to commercial real estate, big scale properties without pouring in a ton of money and time and energy.
So let's hop right into our conversation. So, Tracy, let's get some perspective on real estate investing. As many Canadians might know it, they know it as buying a rental property. But what would someone who wants to invest in rental properties need to prepare for before diving in, based on your experience?
If you ever want to become an entrepreneur, this is a great way. It's a semi-passive way of owning a business. So think of it as one rental property is owning a semi-passive business. And that can be done in your spare time. And then you could see potential in a property that's a diamond in the rough. And so investing is like quite similar to the stock market. You look for undervalued companies with growth potential or actually showing growth, and you buy at a great price. And a company that grows and makes a lot of dough, makes cash flow. So for rental property, you want to look for the same thing where the property is located in a city that's a growing population, growing demand for jobs, has a lot of demand, and then you want to find it in a great neighborhood, near transit, pick a nice property that attracts nice tenants. So in a nutshell, you've got to be prepared to own a semi-passive business, but it's a great introduction to entrepreneurship.
All right, so how would you say investing in a REIT compares to owning rental property in terms of the time, the effort, and the capital required based on your experience?
Well, as a rental property, you definitely juggle a ton of hats. Being you're also on one day you're a bookkeeper, then you gotta collect the rent, you got to market the property, then you're a researcher of where to post the advertising. It's a lot of hats to juggle, so you could see that's quite time consuming, especially in the beginning stages. Once you know done it a few times, you can definitely make it very limited to 1 to 2 hours a month. But in the beginning, it's very time intensive. It's just a huge learning curve. So when I got introduced into the REITs, it just is the opposite end, where you need to be good with letting go of control. You don't need to juggle as many hats. You literally click a button and then buy a REIT that fits in within your portfolio and your style of investing.
All right, so since we're speaking about REITs right now, so tell us, what is a real estate investment trust and how does it work at a high level?
Simply speaking, a real estate investment trust is a corporation that owns a basket of rental properties or apartment buildings. Just think of like the shopping malls. They have an entity that runs all that, and then you can gain exposure to it by buying it in a form of a stock, and it's publicly traded in the stock market. And you get, by buying one of these REITs, you gain exposure to real estate without having you to run the business. So effectively, you can actually have some real estate in your stock portfolio without needing to put in energy, time, and you just need a small amount of capital. It's a lot of them are very reachable, achievable for investors, and REITs generate revenue by collecting income, rental income from the properties that they own, the tenants that they have, and they do charge investors a management fee, but that covers maintenance and acquisition of the properties. But the income that they collect also gets it's like they got a lot of tax incentives, and so they, after all expenses, they primarily distribute, after all expenses, a portion to income investors, being you, if you own a REIT, as a cash distribution, which is in the form of a monthly distribution. So for a lot of income investors, being those who are close to retirement, planning to retire, and want exposure to real estate that's like steady Eddie, you could collect a monthly distribution to supplement your living costs.
All right, so thanks for highlighting that. So now, speaking of REITs, so what are the different types of REITs available to investors?
Yeah, so there are three forms of REITs. There's the equity REIT, the mortgage REIT, and the hybrid. The equity REIT is probably what most people are familiar with, where a company can own physical properties, and they distribute that rental income after all expenses back to shareholders. So they include residential units, industrial, healthcare, that sort of thing. And then you have mortgage REITs. Okay, that's a definitely different type of REIT where you become that company is like a mini bank. Okay, they loan money to builders. And so they're very, very sensitive to interest rate fluctuations. So I would say, in my humble opinion, this is the riskiest in an environment where interest rates are obviously fluctuating. So, but at the same time, the yields, being the distributions that you can collect from a mortgage REIT, are generally higher. But that's a risk versus reward trade-off. And then hybrid REITs are just a combination of a mortgage REIT and equity REIT, being that company could be partly like own a bunch of commercial properties, but then they have an arm where they loan money to builders.
Why might an investor then want to hold REITs as opposed to, other types of investments? Because we mentioned investors who are more income investors may utilize this. So why would an investor choose a REIT over, things like dividend stocks?
Well, simply because they want to diversify. So, sure, it's great to own a lot of dividend stocks in Canada, but a lot of them are heavily on banks, energy, utilities. So, if you want to diversify your portfolio, you would want to consider real estate. It's something that's more tangible. It's also just, makes sense as a business, is easy to understand as a business model. It's also could be like, think of it as an exposure like bond. So instead of buying a bond that's just barely covering inflation or even slightly under inflation, like real estate could be thought of as a very long-term bond where you're thinking that it could keep up with inflation over time, assuming that you did the research and bought a very good REIT that covers a great city that's a growing population, has demand, et cetera, et cetera. Because not all REITs, and just like with not all rental properties and not all housing goes up with inflation. It depends on the market.
All right, so I want to go back to a point you made about tax efficiency of REIT distributions.
Mm-hmm.
And so REITs have a unique tax structure that investors should consider before investing. So can you break that down for us?
For sure. So the REITs they actually distribute a huge proportion of their profits back to shareholders. And it's in their advantage to do that, just the way it's set up. But at the same time, it means it could be a bit more complicated for people who are shareholders, because now you're getting these distributions that actually have all different flavors. So the flavors are, you could have a flavor where part of it is considered your rental income, net rental income. This is just treated as additional income for tax purposes. Then you have part of the distribution is a capital gain. So that means that a portion of that is when they sell a property and they actually gained money off of it. Part of that is considered a capital gain, where in Canada, very lucky, 50% of that is taxed as a capital gain. And then you have another flavor called return of capital. And that's really refunding the initial investment. So if the company in this, being the REIT, sells some of their properties, they do return a bunch of that as a return of capital. And that is also subtracted from the initial price that they paid for that property or the set of properties. So any leftover profit is treated as a capital gain for tax purposes. So there's 3 different flavors, unfortunately, and it's a bit more complicated. So if you don't want to even think about it, just make sure you invest your REITs in tax advantage accounts, being an RRSP, an RESP, a TFSA, anything that's tax advantage, or a LIRA, for example. If you invest outside of those tax advantage accounts, and then you're going to get hit with a more complicated tax structure. It's not as tax efficient if you have it outside of a tax advantage account, and it's just more complicated to track. So your accountant would, if you have a great accountant, they could do that for you. But if you did this personally, it could be a pain in the butt.
All right. So I know you touched on it a little bit. So how might an investor help minimize the amount of tax they pay when investing in REIT? So I know we talked about using some of these tax advantaged accounts. Is there anything else they want to consider there?
Yeah, for sure. If you own a REIT that's foreign, mean like say it's a US REIT, and then you definitely want to make sure you park that in your RRSP. If you park it in, say, a TFSA, unfortunately, there's a 15% withholding tax on foreign dividends. So anything outside of Canada. So you got to make sure that if you're going to purchase a REIT, where is it located? If it's a Canadian REIT, it makes it so easy. You could own it in any tax advantage account. But if you own a US REIT, then put it into RSP so that you can avoid the 15% withholding tax.
And that's because the U.S. doesn't recognize, the tax-free savings account as a tax shelter.
Exactly.
All right, so Tracy, let's talk about some of the key factors you look for when evaluating REITs. So the first is the quality of the properties. So what do you like to see prioritized in the portfolio?
It's very, very like cliche, but it's literally location, location, location. So for me, I very much focus on where the REIT has invested in their apartment buildings, commercial properties. Where are they? I wouldn't be looking at. Hopefully, they're not investing in small towns. Obviously, I always think about like the growth. Grow, 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 and make a lot of cash flow, make a lot of dough. So to me, like you got to go for an area that's largely in demand. I mean, the population's growing, the city's growing. It's got great transit. Just all those. So urban cities is where I focus on because like Montreal, Vancouver, Toronto, Ottawa, even. And I also personally, just out of simplicity, I like seeing them. So if I go into Ottawa and I go shopping, I'd be like, oh, what are those commercial? Who owns those commercial properties? And I could tell easily if there's a lot of traffic in those, and did they pick the location? Like you could tell if you're walking to a shopping mall if it's busy, and then you're like looking up the who owns it, and you're like, oh, this is traded on the stock market, and so you could see it. It's more tangible to you. So that's like on a qualitative perspective. From a quantitative perspective, obviously you want to look at, are they increasing, is there projections where they can increase their rental income? Typically it's quite easy with commercial properties. There's a certain amount you can raise rents, and just making sure that they do that. They also are making very smart acquisitions, so then I would look at that.
All right. And I love how practical you just made that, right? You said you're walking into places to actually take a look and see, is this where my money is going type thing. So I really love that. And I know one of the mantras that we often hear about real estate is location, location, location. So you talked about that, and you talked about, bigger cities, but is this something you literally practice in terms of going into specific neighborhoods to check out the REITs that you're investing in?
So for me, I feel like if you want to follow the principles of Warren Buffett, Peter Lynch, is just investing in a circle of competency where you can see it, so that you can also gauge if anything bad happens in the market, which we're facing a bear market right now, very prolonged bear market. You're not going to ditch your investments. It's a long-term buy and hold. So if you don't know where the properties are located, and say, just because the rest of the stock market took a haircut, your REITs are going to get hit. Are you going to sell right away? Or do you know that, hey, I could see down the street that commercial property still has a ton of traffic, and I'm very confident that REIT is going to still do well. You could see it, so it's more tangible. So you're not going to be as emotional and sell if things go hairy. Being in the stock market, it doesn't reflect the company in itself.
All right. So I know another factor you look at is the sector factor, and you look at how the REIT is performing during periods of market stress. So why do you feel this is so important, and how do you gauge a REIT's performance in these times?
Yes, that's a great question. So for me, a very scary time was during the financial crisis, during 2008, 9, that period where Just as a bit of a history, that's when real estate and a lot of people are losing their jobs in the United States, and it did have an impact, a bit of an impact in Canada. And so I always reflect on that and see these companies that exist today, being the REITs, survive. How did they survive during that time? Because that was probably one of the most stressful incidences that happened in the last 20 years. So that's where I would look at the REIT, and I would look back in 2008 and 9. What did they do? Did they cut their distributions? I don't care so much about that the stock had fallen, because every stock had fallen during that time, but more like, did they pay out their distributions? How did they handle it? A lot of REITs would have been really badly hit during that time. If they could survive that catastrophe, it gives me a lot of confidence that this REIT's been through really tough periods of time where they could, handle a lot. Just like, of course, another bad period was during the pandemic. Now, I'm not saying the past would project the future, but it gives you confidence, a bit of confidence, knowing that they were able to handle during those tough periods. And how did they handle it?
All right. Okay. So the third factor you consider is the sustainability of a REIT's distribution income. So, how do you get a handle on this?
So, unfortunately, this is one of the things that are just a bit tricky to find. It's not as simple as going to Yahoo Finance or some website to find this payout ratio. It's actually, you have to do a little bit digging, which is just going to the REITs website and then go into the investor relations. You'll see the presentation, and you just got to scroll through the presentation and find the adjusted funds from operations payout ratio. Typically, you want a payout ratio is less than 75%. Personally, I also want a decent monthly distribution in the range of 3 to 6%. So this is a way for me to say, okay, is it worth it to make that investment? Do I get a decent amount of income every single month? And how confident am I about them sustaining that income distribution? So again, just look at the adjusted funds from operation. This is essentially a measure of their cash flow, the free cash flow, which is all the income that they collect, the rental income that they collect, subtracting all the expenses like their mortgage, like maintenance, etc. And then whatever's left over is distributed to shareholders. Now, of course, they don't want to distribute all of their profits back to you, otherwise they wouldn't have enough to grow themselves. So you want to make sure that's like under 80%. More than 80% of the distributions paid out to you, that it's going to be difficult. It's like you collecting a paycheck every single month, and you have like 95% that goes towards expenses. If anything happens, like a roof needs repair, then you don't have that emergency money kind of set aside. So you want the same with a REIT.
Okay, so evaluating the sustainability of a REIT's income distribution is an important part of the research process. So I wanted to take a moment to hop into OneBroker to show our viewers where they can find that data. Starting off, we're going to click on Research. Under Markets, we'll go Indices. An index measures the performance of a group of securities. Scrolling down, we're going to click on Sector Indices, and sticking with the Canadian sector indices, we're going to click on the TSX REIT. A box pops up, and we're going to click to view the members. You're able to filter the information on this table by market cap as well as dividend yield, but if you want to filter by performance, simply click on Performance, and we'll filter the table by year-to-date performance. Right now, we'll choose the REIT at the top of the table, click on it, and go Overview. Once here, let's look at some additional information about this REIT. To do so, we'll click on Fundamentals. On this page, you're able to see information such as the earnings per share, as well as the cash flow for this specific REIT. Scrolling down, you'd be able to see information such as the annual dividend rate, which is $1.17, compared to the industry average of $1.24. You're also able to see the dividend yield as well as the payout ratio. Now, the dividend payout ratio is a percentage of net income paid out as dividends to investors. And this also tells investors just how sustainable the dividend being paid out to investors are over the long term based on the earnings of that specific company. Now, scrolling up, you're able to see some additional information. This time we'll go under events, under dividends, and this table gives us a history of the dividend payments of this specific REIT, up to 4 years in the past. So right now you can see in 2023, this REIT is paying $1.17 annually, and you'll see in 2022 it paid $1.08. Finally, if we scroll down to 2019, you're able to see this REIT was paying $1. So essentially, you can see that this REIT has been increasing its annual dividend payment to its investors. Now let's look at another way you can research REITs. Clicking on Research, under Tools, we're going to go Screeners. The Screeners tool allows investors filter for information that's important to them. So I'm going to click on Screening. Once here, I'm going to clear this table. Under my exchange, I'm going to choose the Toronto Stock Exchange. Now to find REITs, I will simply go More Criteria, Sector and Industry. I will clear this table and click on the drop-down by real estate and select REITs. This now tells me there's 46 companies. I'll add a few more filters. Going More Criteria, I'm going to go Dividend Yield. I want a minimum of 3% and a maximum of 10%. I'm now presented with 40 different matches. Finally, I'm going to go More Criteria, and I'll click on Dividend Growth Rates 5-year average. And in this instance, I'm simply going to put 0% as my minimum with no cap on my maximum. I'm now presented with 14 matches. I can filter through this information, and once I pick a REIT that I'm interested in exploring a little more, I simply select the drop-down, click on the overview page, and start my research over again. All right, so Tracy, moving on to the fourth factor on your REIT research list, it is the degree of leverage a REIT has assumed. So what metrics do you use to determine this, and what sort of level do you like to see?
So it's called the debt to asset ratio. So simply speaking, it's like you, for example, you could, hopefully don't have credit card debt, but say if you collect, say, $60,000 a year, you wouldn't want your credit card debt to be $60,000, okay, in that 1 year, because that just means that you don't have a lot of, if you want to pay out your credit card debt, you'd have to wipe out your entire salary for the year. Same with a REIT. I look for a debt to asset ratio. I know I'm very conservative, ideally 50%, meaning that the value of their properties are worth so much more than what they have as debt. And where you can find that is a lot of these free websites will show you its book value versus its debt. I also look at it from a real estate point of view. Like, I want to know what is the worth, the market value of their assets, which is a bit more advanced. You need to know obviously the property values. You can do it by conversion, but simply speaking, you could just look at book value versus debt, which is I like to look for under 50%. And book value, the reason why I just want to give a bit of a flag, book value is at a certain time. So if a book value was determined 2 years ago, you could see, like, if it was located in Toronto 2 years ago, the real estate values were probably a little bit lower than it is today. So that's why I'm saying book value could be underrepresenting the asset value of the REIT.
Okay, and so let's talk about the last factor, and that is how invested a REIT's management team is in its success. So why is this important, and how do you get a sense of this?
So I always want to see management with skin in the game. That's a big deal for me. So for example, you want the CEO or the vice president, the president, to actually own a portion of their own company. Ideally, the higher, the better. I don't have a minimum number. It's not like it's just got to be like an actual like 1%, 2%, ideally more than that, because that means that they really believe in the company, that they've invested their own money back into the company, because they know that why would you do if you didn't have any faith in the company, then that gives me a sign that you didn't even invest in your company. If I could see that, then it's like, oh, maybe I'm not as interested anymore, because to me it's like it just makes sense that you would own a portion of the company because it pays more than even your salary. So that's portion why I look for that. You can find that type of information on a lot of free websites.
And that also tells you as the investor that they believe this company is going in the right direction, right? Of course, you're going on the assumption they don't have additional information you don't, but if they're like you as an investor and they believe they like the direction this company is going in, it increases your confidence if you decide you want to hop in as well. If management actually believes in the direction they're leading this company.
Oh, for sure. Yeah, exactly. It's like it's like they have a vision because they say that in their investors presentation, and then you look at the books and you're like, hey, you have nothing, no money invested in this company, but you just gave this grandiose vision in investors presentation. It gives you a signal.
All right, Tracy, we're going to have to leave our conversation there. Thanks so much for sharing your perspective on researching REITs. And so, do you have any final thoughts you'd like to share with our audience on, our conversation today?
A very approachable way to look at REITs is go walk around, do some shopping, and look at these properties, these buildings, these apartment buildings, these commercial properties, the shopping malls with a new light and say, oh, who owns this and is it traded in the stock market?
I love that tip. And I live in Toronto. So it's a great opportunity to actually go out and take a look at the things you can actually see and see if they're worth investing in, right? So thanks again for joining us. And to those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.